Welcome to Investors Meeting Point. This video presents the critical analysis of Axis Bank's operating and financial performance and the scope for long-term investments in the stock of Axis Bank. Axis Bank's net interest income has grown consistently from Q2 financial year 24 to Q2 FY 25, reaching 134.8 billion. The rise in NII reflects the bank's effective management of its interest-earning assets such as loans. The 9.5% year-over-year growth in NII indicates strong revenue from its core lending operations, despite no further growth between Q2 and Q3 of financial year 25. This stagnation could suggest a tightening interest rate spread or increased competition in the lending market. But overall, the bank's NII remains robust, signaling a healthy interest margin and effective deployment of assets. The loan growth for Axis Bank has shown a significant slowdown, dropping from 22.8% in Q2 to 11.4% in Q2 25. This decrease highlights caution in corporate lending, potentially due to heightened macroeconomic uncertainty or increased provisioning requirements. The decline in growth rates could also reflect a more conservative approach by the bank, focusing on quality over quantity in its loan portfolio. This slower growth may impact revenue expansion in the near term unless the bank can focus to higher yielding retail or SME segments. The gross NPA rates has improved from 1.7% to 1.4%, while the net NPA has remained stable at 0.3%. This indicates that despite some economic stress and retail slippages, the bank has managed its bad loans effectively. The stable net NPA figure suggests that provisions and recoveries have kept pace with new slippages. The improvement in gross NPA also reflects the bank's strong risk management practices and a healthy balance between asset quality and growth, reinforcing investor confidence in its risk management. The provision coverage ratio has declined from 79.5% in Q2 financial year 24 to 76.6% in Q2 financial year 25. While this slight dip may raise concerns about the bank's preparedness for potential bad debts, the ratio remains within a reasonable range. A lower provision coverage ratio might indicate a shift in the bank's strategy, either because of improved asset quality or expectations of lower future defaults. However, the bank may need to carefully balance its provisioning strategy to ensure it is adequately prepared for any future credit risk spikes. Deposit growth year over year has remained relatively stable, hovering around 13.7%, which is healthy but shows some moderation from previous quarters. The consistent growth in deposits is a good sign for the bank's liquidity position, but the lack of acceleration could be a concern if the current and savings accounts growth remains subdued. Deposits are the foundation of a bank's lending operations, and the bank's ability to grow deposits will be crucial in maintaining a stable loan-to-deposit ratio and ensuring that it has sufficient funds to support its loan growth ambitions. The operating profit growth of 24.1% year over year in Q2 financial year 25 is a significant positive indicator for the bank. This impressive growth is driven by strong fee income, operational efficiencies, and controlled costs. Despite a dip in earlier quarters, the bounce back in Q2 reflects the bank's ability to generate profit even in challenging environments. This consistent profit growth should reassure investors about the bank's profitability potential, particularly if it continues to manage its cost and boost non-interest income. Axis Bank's loan book is predominantly retail, comprising 59.9% of total advances as of Q2 financial year 25. The corporate loans share has declined slightly to 29.1%, while SME loans have shown resilience, rising to 11% of the total. This shift reflects the bank's strategy to diversify into higher yielding and less volatile retail and SME segments. A stronger retail focus, particularly in secured products like home loans, is likely to provide more stable growth and reduced risk, though the corporate loans book remains crucial for long-term profitability. The cost-to-income ratio has improved to 47.6%, suggesting that Axis Bank has been able to manage its operational costs efficiently while still growing its income base. A lower cost to income ratio reflects better operational leverage and cost efficiency, which is a positive sign for future profitability. Continued improvement in this ratio would indicate that the bank can sustain its growth without disproportionately increasing its expenses, further enhancing shareholders' value. Return on assets ratio has remained stable around 1.7%, while return on equity saw a slight dip from 18% to 15.9%. The stable ROA indicates consistent profit generation related to the bank's total assets, a critical metric of efficiency. However, the decline in ROE suggests that equity holders are seeing slightly lower return on their capital. This could be due to increased provisioning or slower earning growth related to the capital base, but the number still indicates a relatively strong performance compared to the broader industry. Within retail loans, loan against property has seen strong year-over-year growth at 25.7%, while home loans have grown more modestly at 5.4%. Auto loans have shown a slower growth at 5.6% year-over-year. The strong performance in loan against property suggests that Axis Bank has been successful in tapping into secured lending products, which typically offer higher yield and lower risk. The slowdown in home loans and auto loans reflects broader market trends in these segments, but highlights the bank's ability to diversify its retail loan books and maintain growth in other assets. The results, including steady net interest income growth and improved loan book performance, have helped restore investors' confidence. The trading volumes indicate increased activity during price surges, possibly around earnings announcements or major market events. From an investment perspective, analysts may view the current price level as a potential buying opportunity, given the bank's solid operational metrics and recovery from the recent corrections. However, given the stock's historical volatility, investors should carefully evaluate their risk tolerance before making decisions, considering both the bank's prospects and broader market dynamics.